what's your kind of take on this current focus, regulatory focus, how you're responding?
Well, I think the focus is right. I think, fundamentally, whenever there is a material change in the structure of any industry, which we've actually seen in the life and annuity reinsurance business over the last 15 years, it takes time for the risks to be fully understood, right? It takes time. You actually need to go through a real credit and liquidity cycle to understand where the potholes are.
Yeah.
And I think the regulators, broadly writ, within Bermuda and the United States through the NAIC, are doing the right thing and trying to truly understand where the risks are in the system and to get ahead of them.
Yeah. Okay, let's go along the line. Mike, do you agree with that?
Thanks. In my career, I've actually worked with regulators in the US, Japan, Korea. And the first time I met the senior leadership at the BMA was January of last year. And the first thing they said as they were outlining the objectives for us was they're very focused on customer protection, first and foremost. And immediately that resonated with me because no matter what role we play in different places, whether or not it's property and casualty or life insurance, direct carrier or the reinsurer or the regulators, we all play that role of customer protection first. We make promises. And it's not only important to make promises, it's extremely important to keep promises. So the roles that we all play is all about making sure we can keep those promises. Those promises can get very complex. And that is all, understanding it very well. And that focus on the customer really resonated with me when we first met. And that is something that cuts across global.
Greta, as obviously the pendulum is swinging towards greater regulatory oversight and like extra capital charges and approval of transactions, and it's all kind of going in one direction. How is that changing the funded reinsurance kind of model you've operated with?
Yeah, so as I think about regulation overall, I think we've all experienced like the financial crisis, and we all saw what happened with regulation before and what happened with regulation after. So I think as an industry, more regulation does not necessarily scare us because we are aware of what the unknown unknowns are, right? And we want to make sure we've got the right balance of risk-taking versus risk-reward. I think what's really important is that we maintain, the right governance structure that's fit for purpose for today, but also the future and where we're going, that we're able to, help innovate and create, potential solutions that help us cover the protection gap that's out there. I mean, that is deeply, very troubling.
Yeah.
How many people out there are not protected for the future. So I want to make sure that we're able to still innovate, and then we also need to provide reasonable risk-adjusted returns to those that are putting capital into the industry.
Yeah. I mean, we've seen time and time again that regulation can favor, extra regulation can favor big established groups and kind of help entrench them. It also can foster technology and bring you in here. Obviously, you provide asset liability modeling kind of tech. I'd imagine the regulation is a tailwind to your business, but yeah.
Absolutely.
How do you see it playing?
Yeah, I just listening to what Martin was saying earlier, we endorse what the BMA is doing here. These are, we're in the long-term sector here. We need to be around 30, 40, 50 years from now to pay these policyholder claims. And risks are getting more complex, they're getting more interconnected. And so, we endorse what the BMA is doing. We commend what they're doing in making sure it's an appropriate regulatory framework. And the jurisdiction has gained such great international credibility and a great reputation. And one of the main reasons for that is the sophistication of our regulatory framework. It's a principles-based regulatory framework that we really need to maintain, and we need to ensure it's being enhanced to keep up with the risks that are out there. Ultimately, it's about protecting the policyholder. And we'll talk more about technology, but and we heard from the AI session as well earlier, as governance gets more complex, how can we leverage technology to ensure that we have the appropriate tools to ensure not just appropriate regulation, but regulation that is really relevant for the future, and as these risks are evolving, how does regulation and governance evolve as well?
Yeah. The other three panelists on the stage obviously all represent groups that have links to or are part owned by or founded by kind of private capital groups or private equity firms or sponsors, depending which kind of terminology you use. And obviously all these structures are different. And then what we're seeing now is them kind of being stress tested and greater regulatory focus on them. Imran, if I ask you a very simple question, how do you make regulators comfortable, or how do you demonstrate that the assets being put on that you're putting on your balance sheet are in the interests of the ultimate annuitants and people that are being protected by what you do, as opposed to, Sixth Street's kind of what's in their interest?
Yeah, I think it's a right question. The BMA, if I think about what Gerald and Martin have been pushing over the last few years, is really sort of making sure that the prudent person principle is sitting in these companies, right? That my chief investment officer, who works for me, right, not for Sixth Street, is very focused on understanding the assets, the risk profile of the assets, right? We have an open architecture model on the asset side. And what that means is the vast majority of our assets are managed by unaffiliated third parties. And for us, that's very central, right? Because that allows us to get the best of the breed in terms of the managers out there and negotiate the best rates and produce then reasonable returns for our equity holders, but for us to be here for the very long term for the policyholders. One of the concerns that we have in the industry is actually sort of who is actually keeping the asset managers honest when it comes to what they're putting onto the balance sheets. Because in this new world where they're interesting assets, they're structured products, levered credit, they're more illiquid assets that are being put into insurance company balance sheets in the United States and Bermuda and Cayman, all over. Someone needs to be fundamentally responsible for understanding those assets, understanding those risks, understanding the marks. And when the insurance company is fundamentally independent like ours, where the CIO and the CFO are very focused on ensuring that truth on our balance sheet, it gets me comfort. My concern is actually when you have other enterprises, and many business models survive in the market and they're fine, right? But how are those other business models really ensuring the prudent person principle is being adhered to, and that the CIOs in those insurance companies are truly independent, right? I mean, we've heard in the industry others talk about these policyholder liabilities, these insurance companies as presenting an amazing source of permanent capital for the asset managers, right? Two words that should never be used to apply to a policyholder obligation, right? It's not permanent. We saw spikes and lapses last year that most insurance companies were not prepared for.
Yeah.
And it's not your capital, right? It's actually something that the policyholder's given you, and you have a sacred obligation to give it back. And that's what we and others in the industry need to be doing.
Greta, can I bring you in on that? How do you make sure that the assets that you have as CFO are, in the interest of those ultimate savers as opposed to, Carlisle's interest?
I was hoping you would.
Yeah.
So I have worked for multiple ownership structures. I've worked for the public company environment, I've worked for private company, I've worked for mutual, and all three of those, and now, backed by private equity, and all of those environments operate completely differently. I am absolutely amazed at the level of rigor, the level of sophistication that our board and our investors have as they interact with us. It's not a board, an investor group that sits away and they're very passive. No, they're very, very interested in protecting the company overall in the business that we're building. They're not short-term investors or long-term, and they are constantly challenging us to innovate, to do things better, to create a safe, stable balance sheet with strong financial strength. So I take the flip side of that, where private.
It's a balance sheet with more liquidity risk than a kind of traditional life reinsurance company, right? You are taking risks that regulators are highlighting and concerned about. How do you get comfortable that you won't get into the scenario that Imran described? Where you might have lapses, liquidity stresses on your business, and then you've actually tied up more of your assets in hard to sell places, maybe not Everton Football Club, but maybe litigation, aviation finance, or kind of assets that it can be difficult to kind of sell.
Absolutely. It's all about stress testing, risk management. Like, we are in the business of taking risk, assessing risk, and managing risk. So it's all about how we do asset liability management, how we do our hedging strategies, et cetera, et cetera.
Mike, how about your thoughts on this question of independence, whether you're, and it seems to be key, that relationship between the insurer and the asset manager, the power relationship there, how do you put the governance and make sure, or, do some ownership models just not have the level of independence that are needed?
Yeah, and I think I come back to my comment about promises, because that's where you can get everybody focused on what is the liability, what is that promise? How does it emerge itself over time, and what risk can it be susceptible to under stress? Something like structured settlements, very stable. Something more lapse sensitive, really need to understand that. And then that's where we start in saying, what is that nature? What are the characteristics? How do I build then the asset portfolio around that liability that sustains that cash flow, not just underneath base case, but under stress scenarios, most importantly? Especially when we think like lapse experience and stuff like that, which is, what will actually happen? What will lapse? And then how do you think about the portfolio in that context? Is the way that we keep that independence and that focus back to that promise. And no matter where you sit on the actuarial side, the investment side, the CFO side, the board, and our engagement with our regulators, that's how we keep that focus around that to address the independence, to make sure we're getting that right and people are comfortable. And then tying back into doing extensive stress testing to make sure what can happen before it happens. Absolutely.
Before we move on to talk about technology, because I want to bring you back in, obviously international regulators are chasing these risks around the globe to some degree. Bermuda is tightening in this area. There are some territories that aren't tightening, and obviously we know how these things play out. A lot of the business will go there. Some people that choose to be in a more regulated environment for their own reasons, or because their domestic regulators want them to, will stay. Do you think that we might see is that going to be the next area of concern, that, we'll see funded reinsurance business, more of it move from, like as Bermuda tightens, to jurisdictions that aren't as rigorous on the kind of connected party investments and liquidity risks as the BMA is now being? Does anyone have a view on that, do you think?
Yeah, I can jump in. Ian, from the Agam perspective, as I mentioned earlier, we think what's happening here, the enhanced regulatory framework is the right thing to do. It maintains that international credibility of the jurisdiction. So we continue to invest significantly in Bermuda. We're very bullish about the growth here in Bermuda, particularly in the life and retirement space.
Does anyone else see, Cayman mounting it?
I just want to make one comment. It was interesting. I think it was, Jeff made a comment about how, it almost seems that some of the regulators are in competition or adversarial.
Yes.
Right. We just had our supervisory college last week, actually.
We did as well.
Three regulators, very collegial, and what heartens me is actually how much they're working together to make sure that they understand our business, right, collectively, right, because they want to make sure that the gaps between them are actually being covered. And so that actually gets me more comfort. And just having the right, individuals at the regulatory organizations who are capable of actually doing the analysis, right? Because our businesses are heavily analytical. I think Jeff said, who grows up wanting to be in the insurance space? I didn't. Right? And
that you?
I wanted to be a neurosurgeon, so I'm still a failure in my mother's eyes. And but the reality is, it's hard work. And so for the regulators to actually have the personnel on staff to actually deal with the data that we're providing them is important. And for me, I'm actually heartened by the amount of regulation and the supervisory college sort of focus on making sure that it's all being tied together.
Yeah. Greta?
Oh, I was going to say the same thing, that
we're going to have to start finding some areas to disagree.
yeah, we should. No, but I do think that the various regulatory bodies, I think it's healthy for them to challenge each other, to make things more robust, to find and close the gaps in the environment. Like, we all know that the financial industry is connected, highly connected. So it's not in our best interest at all to have places where there are issues, where people can go to hide, where Like, we don't want that. We're not interested in doing that at all.
Interesting kind of subsuite, if I may describe it that way, from the BMA talk just now, is the idea that, obviously in ModCo structures, yes, the assets do stay, in the US or wherever. But it doesn't mean things can't go wrong, and actually the governance and the regulation in the jurisdiction to which you reinsure is very important, and that's why a lot of people are here. And, whether the regulator falls short is not, just because the assets have stayed in the US, it was pretty meaningless in the 777 Re case, it still went wrong. And maybe that went wrong because US state-by-state regulators are not on top of how ModCos work. I'm not really asking for a comment on that, but I suppose, do you think to some degree it's the tightening that's being done by the kind of ceding regulators that's more important here in terms of how it's going to change the business? Or are people reassessing ModCo, that's a simpler way of answering the question, as a kind of where the risks are in that structure? Did we really understand it? I mean, obviously you would say yes. But yeah, is there any reassessment of the structures, I suppose? Mike?
When I think about the structures, I think about the form of the transaction to help both sides get comfortable. And, sure, keeping in funds withheld and ModCo, keeping those assets on the insurer's books is an easier story because you're not even moving the assets. But we also do a lot of co-insurance as well, and we are moving the assets. So we take that form of reinsurance as well. And then it's well, what are you doing with those assets and, setting up the trust account, setting up appropriate collateral to make that work as well. Mm-hmm. So I think different forms are just for different purposes, but making that work regardless of the form and making sure that the assets are there, the collateral is there, regardless of whose balance sheet they sit on, is absolutely a focus. And if Amy was here, she stresses that word collateral and collateral adequacy and understanding of that over and over again, because that's the comfort that both sides in that transaction need to have in order to feel comfortable proceeding.
What kind of technologies are interesting here or might be adopted more going forward to make sure, asset liability modelling is being done in a really robust way? Probably start with the provider, sure. But then you'd love to get others.
It's and maybe just a step back before I come to that. It's also about the risk culture of an organization. We talked about the governance piece. I agree with what Imran was saying earlier as well. It's a liability-driven, or it should be a liability-driven asset strategy that these companies adopt. So it's not so much whether the business model is nuanced or not. It's how do you operate within that new business model? This new open architecture business model is here and is here to stay. What's important is how is it governed? How do you govern that new structure? And governance and risk culture is really important. And within that liability-driven asset strategy, what's really important is understanding that liability profile and then matching it with appropriate assets. So when you look at ALM, it's such a core fundamental way of managing interest rate risks within our businesses that you need the right technology. So what we've done at Agam is we've developed an integrated approach to modeling assets and liabilities in one integrated system. So there's one source of truth, and we spend a lot of time on the analytics rather than questioning the integrity of the data. It's about not just absolute movements in interest rates, but the slope of the curve changes as well. And we've seen that recently, from the middle of April to the end of the second, third quarter, we saw interest rates move in a very volatile way, and that has significant impacts to our businesses, both on the assets and the liability side of our balance sheet. So how do you manage that risk? What real-time information are you getting? Because the target is changing, right? You're trying to target a particular key rate duration, but that is changing on a daily, weekly basis. So are you getting that information back to your CIO?
Does anyone want to come in on that?
You need to manage to that.
Yeah, I mean, I 100% agree with what Anup is saying. First of all, risk culture matters, liability-driven organization matters, and then understanding the variability, around our balance sheets. You can't project it, right? John, where's John Heel, right? The AI stuff is amazing. AI is basically just trying to come up with a better line of best fit, a better regression analysis with a lot more data, paying a lot more money to GPU providers, right? At the end of the day, right, we need to actually build buffers into our system, right? With these kind of businesses that we have where you owe something back to someone else, a policyholder, you need buffers, right? For us, it's cash. It's cash, it's treasuries, right? We have large amounts of it, on our balance sheet, to be careful. And we think, our business model allows us to do that because, we have flexibility in what we can do on the asset side. But I think that primary focus of how do I pay that liability holder back, the policyholder back, if it's dominant in your mind and it's dominant in your business model, then you actually start to build a lot of buffers in your system because these systems cannot be 100% predicted.
But liability-driven investment systems can also go quite badly wrong. We saw that in the UK after the mini budget when all the kind of gilt repo that pension funds were doing in their LDI strategy just suddenly turned out they had loads of leveraged gilt holdings.
I think that's poor ALM.
Yeah.
I'll go to Anup. I think that's just fundamentally poor ALM.
Yeah.
That's it.
Yeah. Anyone else want to come in on the tech of it? How, Mike?
Yeah, and I agree. When we think about over time, and we were just talking before about how we're accountants by trade, and so I always
Tell everyone that.
I always go back to that T account. I know it, but how foundational is that? But when you go back to the famous T account and that line in the middle, and assets on one side and the liabilities on the other side, that middle of that T account can often be a line. And this is all about ALM and good ALM and bringing that together and having that technology that Anup described to say, not just in the base case model and what you're expecting, but to try a whole bunch of different scenarios and things that can go wrong, because that's what we know will happen in the end, not what you expect. And that technology to be able to do that fast and together is so critical. And that's exactly why we work with Anup and team, the Agam team on that support as well.
I want to give the audience a chance to ask a question of our panel, or just to get you cogitating. Yeah, we've got a question in the middle here. I think the microphone's coming around here. Pass it down.
So I might have to provide context to the question, so bear with me. You talk a lot about ALM and proper risk, culture, and the points about having a CIO who's independent of maybe the influence from the top, given the propensity to take on more illiquid credit, which is all good and well. But I think there is very clear evidence that in the industry, private equity-owned insurers, on average, right, have a much higher risk appetite than the traditional firms. So even arguably the independence, is a little bit sort of at risk if that risk appetite is a little bit too extreme. And also just
I'm going to have to push you to come to a question.
Yeah. So the ALM side it works very much in a traditional sense, right? My question is, how do you get comfort around the complexity of risk and all the unknown unknowns, in particular the fact that there's a lot of private credit that hasn't been tested, given we haven't seen the end of a credit cycle, coupled with a lot of correlation of risk across both the assets and the liability side?
Greta or Imran after?
I can start off. I think what's really important is the independence of, we're managing fundamentally a reinsurance company here, not a total return hedge fund. So you have to look at that independence, and that's fundamental. So, and once you've made that separation, that independent separation, then you look at the liability profile of that reinsurance entity, and all the other things that we talked about are relevant here. That prudent person principle, the liability-driven asset strategy, but it needs to be independent of the parent company.
Okay, and then aside from the government, on this kind of souring of what everyone's worried about, the Bank of England, everyone, the souring of private credit in a kind of dramatic way that hasn't been tested and to which certain insurers are more exposed than others. Imran?
First of all, it's a right question. Absolutely. Second is, it is business model agnostic. That's where I would actually differ. I'd say there are a lot of mutuals and large stockholders in the United States who've actually shifted quite a bit, both to business model perspective, where the asset manager is starting to drive what the insurance company is doing, but also to take more illiquid credit risk. I think it's very fair, and I think that the risk officers at the insurance companies need to be really putting their own lens on stressing, saying, hey, fine, if we have lower defaults today, but then the loss given default is much higher today, let's actually put that into all of our analysis, not the last 15, 20 years of analysis of work. And then, what do insurance companies do to ensure that they have excess capital or excess liquidity buffers in the system? So it's the right question, but I think that's really what the regulators are also very focused on too, is making sure that the insurance companies have the actual conservatism in how they're being run to survive some of these stresses with new unknown credit classes.
Greta?
I agree totally with what you say. I think all of the different bodies that are looking at us, the public company, not public company, but the public reporting that we all do, the transparency that we have on the investments, that's all needed. It helps with the level of rigor in how we look at our portfolios. But really it comes down to us really doing scenario analysis, stress testing, all of that very regularly, very thoroughly.
Yeah, and I think the last thing I'd add there too is around the alignment of interest across investor groups, understanding all those things that can happen. Because when I think about buffer, that's why I think about capital in the first place. Capital exists because we take risk. And we need to make sure we have enough capital to cover those risks should they happen. And so we were calling, when we were going live, Prismic as Prudential's third-party capital strategy. And why was to bring capital to fund the complexities of the promises made by insurance companies with the understanding of what those risks actually were, so there was a better alignment of interest versus, say, a public market, which is thinking about Martin's slides. You know, what are you doing for me today, not what you're doing for me 30 years. And therefore, that bringing that capital for the right reasons with the alignment of interest top down, I think addresses a lot of the question, a lot of the risks that you hear out there.
So we've talked a lot about scenario analysis and risk, risk management, risk appetite. I connect it back also to the section on AI and the implications for the life industry. Like, there is so much opportunity here as it relates to our ability to really understand all of the risks that we're taking and our ability to innovate on the product set and how we can think about modeling. That right there is, I believe...
The inputs are going to be crucial too, right? And some of the concern the regulators have around private credit is that it's relying on private credit letter ratings that, like, studies show seem to be more positive than ratings of publicly traded credit. And there is a concern that, PE-linked insurers are getting heavily into private credit, relying on ratings provided by privately owned credit rating agencies, which also seem to come out more positive, and it's kind of speedily provided. And do we even have there's a risk that the whole sector is underplaying the threat from private credit because it's relying on these things. Do you think is that just too doomsday scenario?
Yes.
Yes. Okay.
No.
If I'm edging towards there, that's kind of...
No, but that is, that's our job, to think about the doomsday scenario. And again, that's why I get back to technology and really trying to get as much data as you possibly can, not relying on, a specific valuation from a group or from a rating from somewhere else, but trying to come up with our own thesis on the quality of each position and the level and the number of positions that we have in our portfolios. That's where technology comes into play.
Okay, we've got a chance for just one more question. Does anyone have one?
Maybe just one thing to add to Greta's...
Yeah, especially as I don't think we have a question.
Is also looking at the total asset requirement of your company, right? So there's so many different constraints that you're operating under. It could be, a liquidity stress test, a collateral requirement that is your biting constraint at the moment. It could be a rating agency requirement. So understanding your total asset requirement, not just under your base scenario, but in the future, and stress testing that under different scenarios is really important.
And I echo that too. That's actually how we help bring regulators together on that total asset requirement, because whatever shows up in reserves versus capital, it will be different across regime. Right. But how much assets are you putting against that promise you made is something which is a common denominator, because that's a total. The pieces aren't that important, but what is the total was an area of focus that we help bring that understanding together as well.
Well, just leaves me to thank my panel for a really engaging and detailed discussion on the kind of big questions for this sector. So I really appreciate it. Please join me in thanking them. Thank you.